Another huge one I see, since I work with tech folks and a lot of them have employer stock, is I've seen people pay double the taxes on their employer stock.
This is Techie Personal Finance Bootcamp, where I help tech professionals in their 20s and 30s balance a great life today without sacrificing their future possibilities. I'm your host, Lucas Caceres, certified financial planner and founder of Level Up Financial Planning, where I help educate, coach, and build strategies with my clients to help them take their financial confidence to the next level.
Disclaimer alert. This information's for education, so don't just go use it. First consult with your financial advisor, because that's way more legit. That's it.
That was Orlando Gomez, and you can catch him in season 3, episode 4 on how he broke into tech by writing a jingle. Thank you for joining Techie Personal Finance Bootcamp season 8, and I'm starting this season off with taxes. I'm right in the thick of tax season, about to submit a bunch of returns for clients. And before I do that, I wanted to record this podcast to make sure that you understand the things that you need to consider before filing taxes in 2026. Lots of tax law changes that occurred in 2025. And then there's always just the same things I see that people run into all the time, especially when they're coming to me for the first time, and we start to look back and be like, oh, yep, there's a few mistakes that have been made in the past. So the first one is well within your control, is make sure you have everything you need. And you can use the baseline of what applied to you last year, find all those tax forms, unless you know they do not apply to you. So if you worked at a different employer the previous year and that didn't bleed at all into 2025, then we know you're not going to need a W-2 from that employer. Or if you did contract work and got a 1099, that's not going to apply. So all the old stuff that still is relevant for you, make sure you hunt down that. Then what new changes were there? Was there new bank accounts open, new investment accounts? Did you start receiving RSUs or employer stock? These types of things are going to be additional new things that you'd have to hunt down that you haven't seen before. And another problem I see folks run into when they go out, they're seeing all these advertisements for filing your taxes. Don't forget to file your taxes. If you act now, then you'll save whatever the amount the promotion is. And one of the problems is if you have a complicated financial situation, maybe you have more than one account, more than one income, and different pieces of tax forms all over the place, is many financial institutions actually don't even get your tax form out to you until the middle of the month or the end of February even. And so that's one reason why a lot of folks make mistakes, is they're like, all right, I got everything that's been sent to me, there's nothing missing, and then they submit it. And they don't realize that there's a whole bunch of new tax forms that are going to come in a week or two after they file. Then they have to go through the whole hoop of getting that amended. Be aware of those. Super easy thing to control just by not rushing it. Make sure that you're dotting your I's and crossing your T's. One cool benefit, and this applies every year, is there are a few accounts that you can actually go back and time travel and make contributions for 2025, even though we're already in 2026. And that's through April 15th that you're allowed to do it. Those types of accounts are a traditional IRA, Roth IRA, and a health savings account, also called a HSA account. And the two things you need to know about the traditional IRAs and the Roth IRAs is there's going to be income limits, and you might not be able to make contributions into those accounts. Make sure you're aware of that. As well as for the health savings account, you do need a health insurance plan that makes you eligible to contribute to an HSA. And one giveaway for that is if you're already making HSA contributions through your employer, or if your employer is making HSA contributions on your behalf, that's a giveaway that you're eligible. And if you haven't maxed it out yet, you can manually make a one-time contribution. Make sure you choose the tax year 2025, and then make that contribution, and then make sure you report it on your tax return. So that's a big piece there. If you're looking at your income and you're not eligible to make traditional IRA or Roth IRA contributions, there might be something called a backdoor Roth. If you look back in previous seasons, I did a whole kind of tax series on it, and one of the episodes focused specifically on backdoor Roth conversions and mega backdoor Roth conversions if you had that ability within your 401k. So check that out, see if you would fit the qualifications of that, and make sure that you do that appropriately if that's a different strategy that you'll be moving forward with. So those are the time travel techniques that I like to call them. And then there have been a lot of tax changes, but the nice thing is a lot of those things will happen for you automatically. If you're using TurboTax, If you're going to H&R Block or Liberty Tax, found filing your taxes, you're using somebody else. So there's a lot of things that just happen automatically. So the standard deduction increase will automatically apply for folks. The child tax credit will increase if that applies to your family. Senior tax deduction, if you're older and qualified for those age-based senior tax deductions. And so those things will happen automatically. You don't have to worry about presenting anything just based off of your age, your filing status, whether you're claiming children. Those things will happen automatically for you. So that's nice that you don't have to keep track of those things and make sure that you're getting everything you're entitled to there. But there are some things that won't automatically apply, and it will require you to hunt down some additional documentation that maybe you didn't need to use to in the past. And the big ones are going to be itemized deductions. You might be thinking to yourself that, hey, I haven't had to itemize in a while. Our interest rate's super low on our mortgage, and you just don't qualify. It's better to take the standard deduction. Some of that calculation has changed pretty dramatically because one of the big tax law changes that occurred in 2025 was the state and local tax cap used to be 10,000. So that means if you were paid way more than 10,000 for your state income tax or property tax or a combination of that, and you were only allowed to take 10,000 if you were itemizing your deductions for that because you were capped there. But now that has increased to 40,000. There is a much higher income tax limit, so even high earners still are going to be eligible up to 40,000 for the state and local tax deduction. And so that easily could change you from previously not benefiting from itemizing to saving quite a bit. You could be saving like $9,000 potentially. So yeah, you could be saving a lot more if you're at the higher end of the state and local tax deduction and you qualify and you're able to get that huge tax savings potentially there for folks that are in high income states, high property tax states for sure. So make sure you hunt down that information, make sure you submit that. So the last things I'm going to cover, and there's quite a bit here, so hang with me. I'm going to start from the most relevant, the most common mistakes that I see to maybe less relevant, doesn't impact everybody, but it does make a noticeable impact for folks that it does apply to. The biggest thing I see when folks are doing things themselves or if they're answering questionnaires I send out is filling things out inaccurately. And it's very easy to do. There's lots of weird questions. It's not easy to translate sometimes. And so I've seen people accidentally report income that didn't apply to them. They checked something and then they plugged in numbers that they thought were supposed to go into a field and they ended up paying more taxes than they were supposed to. So I see that quite a bit. And yeah, it's just reported income they didn't have, filling forms out wrong. Another huge one I see since I work with tech folks and a lot of them have employer stock is I've seen people pay double the taxes on their employer stock. And it's crazy that the financial institutions do not always report it accurately to you what the cost basis is. And so if that's the case, if things are not looking right as you're filing your taxes and plugging in your employer stock, there's probably another form that you're missing. It's either later on in that same 1099 that you're reviewing for your employer stock, or it might be a separate form called a supplemental tax form. And so that's going to have all the accurate cost basis. Sometimes you can cross-reference that with what's reported on your W-2. It takes a little bit of research and cross-checking. And so that's something I enjoy doing, making sure my clients do not double paying taxes because yeah, you're already taxed on those benefits once you receive them. And if they're not reported accurately, you end up paying taxes on them again. So definitely avoid doing that. The more stock you have, hopefully the more noticeable it'll be if you are making a mistake. But yeah, sometimes people are just like, oh gosh, I guess it's just because I owe that much, and then they pay it, and the IRS does not do anything to resolve that for you. They don't send you money back, unfortunately. So make sure you report that accurately. Another huge one I see because folks' incomes, they start out their careers, they're originally able to contribute to a traditional IRA and a Roth IRA, and then they get pay raises, they switch employers, they start getting bonuses and RSUs and all these different things, and it pushes them out of the income brackets that would allow them to contribute to a traditional IRA and a Roth. And I see folks contribute to a traditional IRA and not report it on their taxes, so they're paying double taxes on that money. They don't get the tax benefit of contributing to a traditional IRA, which is the main benefit there. And then they pay taxes on that funds when they come out. And yeah, they're definitely paying double taxes if they're not reporting that accurately. But then on the Roth side, it's not an issue of paying double taxes. The issue is that if there's an error and you contribute to a Roth and you're not eligible to, there's penalties and fees for contributing to it, even as it grows. And so you want to unwind that, get that cleaned up ASAP. It is a little bit of a nightmare, so make sure you report it, because as soon as you do your tax person will say, hey, you're not allowed to do it, and you can fix it. Or if you're doing TurboTax will kick out some type of error saying something similar. Hey, you're not allowed to do this. Please have the excess contributions removed. Then it's a little bit of a mess to untangle, but you definitely want to do it sooner rather than later, and definitely make sure that it's accurate moving forward. Again, if you are phased out of those based on your income, look into backdoor Roth contributions, and you can check out the podcast and video that I've done in previous seasons on that. Another thing I see that happens quite a bit is you get a 1099 from rolling over your retirement account. And so make sure you report that accurately, especially because most of the times you are rolling it over into another IRA. So it shouldn't be taxable as long as everything was done correctly. But if you hit the wrong button, if you choose the wrong thing while doing that, I've seen people pay taxes or pay penalties on things that they weren't supposed to. And again, the IRS isn't quick to correct those or fix those for you. Another thing that I've seen is folks that should be itemizing, but they don't. And it's easy to make the mistake if you're just like, I have no clue what that means. I'm not going to look into this and try to figure it out. I'll do the easy thing, take the standard deduction. But I've also seen people just get tricked, because the big issue with this is mortgage companies are always selling your mortgage to a different mortgage company. And if that happens midway through the year, you might only recognize one tax form coming in the mail, and the other one either went to email or you got to go and log in and pull it. And so if you see one tax form for the mortgage company and it only reports part of the interest that you pay for that year, it might not be high enough to push you into the itemizing benefit category. But once we go and hunt down that old one and then combine those together, then you would benefit possibly. And so that's another one where I see all the time that, hey, you itemized last year. For some reason, it doesn't make sense to itemize this year. Why is that so different? And it's very easy when I know my client's situation, be like, hey, this doesn't make sense. And definitely if you've itemized in the past and all of a sudden it's looking like you're not going to be eligible to, definitely make sure you have all of your mortgage tax forms in case there's more than one. A couple of smaller issues is parents who have children that are eligible for dependent care credits, that is free tax money, and even something like a summer camp could be a tax credit for you. So make sure that you're looking into those. I see people be like, oh, I didn't realize, and it's a few $100s that they just kind of miss out on that. It's free for them to report. So make sure you get that if that applies to you. Parents not claiming 529 contributions in a state that allows that state tax deduction. Again, it's free money and no one's going to hunt you down and say, hey, you forgot to do this. So if you make those contributions, just make sure you report them. And state income taxes, like in Colorado and Minnesota and a couple other places that offer that deduction, it's not going to bankrupt you, or it's not going to be thousands of dollars. It's usually a couple $100. But again, free money that's yours and you're entitled to those deductions. Another crazy one, it doesn't apply to all folks, but if you have rental properties and if you have not been depreciating them in the past, it's a little wild, because that's one of the main benefits of rental properties is the ability to depreciate them, offset the income, and reduce your taxes while you're doing that. And I've seen it more than once where clients will be like, oh yeah, we have all these rentals and they haven't been depreciating them. Luckily, there's a way to fix it. It does take a little bit of time. There's extra tax forms. And so that one's relatively easy to fix, but you do want to make sure that you know what you're doing and fill out the form properly so that doesn't get denied as you request the fix for that. And then finally, business owners, self-employed folks, especially if you're just doing one-off contract type stuff, only claim expenses that are legitimate business expenses. I've seen people try to claim like random stuff just because they use a business credit card or pay it out of a business account. That doesn't make it a business expense. It still has to be a true business expense. And yeah, so make sure you don't get in the crosshairs of the IRS for being super aggressive and claiming things that are not expenses. And that would be the last mistake that I see that is a huge one, but I know not everyone listening to this does contract work or is a self-employed person. Reach out if you have any questions. If you're a client of mine, then obviously I'll be able to answer your stuff very much in depth. If you're not, I'm still happy to try to answer questions in between filing taxes and working with my financial planning clients. As much detail as you can provide, I'll be able to give you a general idea and kind of things to think about. I'm not going to be able to give you specific recommendations just because I'm not going to know all the stuff that you didn't include in those details, but always happy to help and looking forward to having more episodes this season. There'll be a lot more towards the end of the year as I get my last little one off to school. Logistics throughout the day will be a lot more flexible, a lot easier for us to navigate on the household standpoint. So yeah, look forward to creating more content. Excited to be back. 2026 is going to be a fun year, and I'm excited to help you navigate any financial questions you have. Thanks for checking this out.
Thank you so much for listening to Techie Personal Finance Bootcamp. You can find show notes by visiting levelupfinancialplanning.com and finding the podcast page. You'll also be able to find strategy guides, videos, and cheat sheets to help you take your financial confidence to the next level. If you feel this episode has added a ton of value for you, please rate and share this with friends and colleagues. Catch you next time on Techie Personal Finance Bootcamp.